I think actually gold could surprise everyone on the upside in the next few months. Some people are saying it's the top, that gold is a bubble. I don't think gold is anywhere near a bubble. It's still heavily underinvested. It's the central banks that are front-running the public and investors. It's a golden age. Revaluation, that's still in the cards, isn't it? And I noticed President Trump said that there's going to be 20 trillion injected into the U.S. economy still in 2025. I'm not sure where he's getting this number from, whether foreigners really want to invest 20 trillion while they're getting away from the dollar, or maybe he's thinking of revaluation of gold. Who knows?
The silver price outperforms the gold price about 2 to 1. From a conjectural perspective, then, if I was one who believes that the gold price should go up threefold in the next 10 years, that would suggest that the gold price goes up sixfold. Right. Is that a projection? I'm not smart enough to give you one. I'm just repeating history as I've lived through it. I don't know how. I don't know why. I just know that.
Gold is entering one of the most explosive phases in modern financial history. Despite corrections and short-term volatility, the long-term structure points decisively higher. Institutional sentiment is shifting, global central banks are accumulating aggressively, and currency confidence continues to erode. With spot gold pushing beyond $4,000 and silver challenging key resistance levels, the market appears far from a bubble. Instead, it remains historically underowned. Price action, supply tightness, and geopolitical reallocations all suggest that gold and silver are preparing for a significant upside surprise in the months ahead. Marioinnecco, a respected macro-analyst, and rickrule, one of the world's most experienced natural resource investors, both highlight the same conclusion. The revaluation of precious metals is accelerating. Their combined decades of market observation point to structural forces: central bank accumulation, collapsing confidence in fiat regimes, and historical ratios between gold and silver that all align with a powerful long-term bullish trend. Across the metals complex, key levels are signaling strength. Silver repeatedly tests the $50 barrier, while gold continues setting new monthly highs. Long-term wave structures, Fibonacci models, and historical gold-silver ratios suggest the current cycle is far from complete. With the dollar losing global dominance, major economies quietly adding to reserves, and volatility increasing across equities, precious metals stand out as one of the few assets positioned for sustained appreciation. The next phase could carry both metals into levels not seen in generations, potentially reshaping portfolios and challenging traditional financial assumptions. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Price for spot gold is $4,053. It's up $53. We closed at $4,000 on Friday, the spot price. The high's been $57 and the low is $39.96. So up 1.3%. While silver is doing really well, it's up almost a dollar. It's up 87 cents or 1.8% at 49.20. The high's been 33. Of course, I don't have to tell you what the key level in silver is. It's 50. And let me have a look here at the chart, the daily chart. We had a high last, when was it? 31st of October. That was at 49.37. That's a bit like a double, well, not a midpoint of a double bottom right now in silver. So if we can go through, let's say, 49.50, that would be very bullish in the short term. Longer term, on the weekly basis, as I said, we're not out of the woods. We still have a lot of room on the upside. And the all-time high was 54.60. That was on the 16th of October. But the longer-term charts, if I look here at the weekly, starting to look better. The monthly chart as well. Right now, if the month ended today, we'd be closing at a new monthly high. So, yeah, we just need to be patient. The other thing that's going to be interesting for me at this summit is to see how many people there are what the mood is, because last year the mood was pretty good, but gold had corrected from almost 2,800 to down to 2,500. It had corrected just like now. And the mood was still good, but 2022 it wasn't really great. Here, Elliott wave analysis, and I'll show it to you here. It's a very long-term chart. He loves looking at long-term things. He thinks a lot of technical analysts, they don't look long-term enough to see the bigger picture. But you can see here he's got a wave 1, and I think that was from 1789 to like 1837. I think there was the panic of 37. That was wave 1. Wave 2 is the low there. Well, the panic of 87 was wave 2, excuse me. The rally was up until 87, and then wave 3 is the top in 1929. The crash is wave 4, and according to him, we're in wave 5 right now. And it's a very long wave. It's since 1932-33, and he thinks this wave is almost over. So we could see a big correction. And if you look here, he's got the big crash in 1929. The market dropped 13% in one day. And then in 87, the market dropped 21%, October 87. So the other thing he looks at is Fibonacci numbers, which is something I do as well. 13% is a Fibonacci number. 21 is a Fibonacci number. If you add 13 in the previous Fibonacci number 8, that's 21. And then you take 21 and you add 13, you get 34. So he thinks we're ripe for some kind of huge crash in one day of 34% in the stock market. And if you look at where we are, a 34% drop would not really look like, let's say, the crash in 29, because we're up so much that it would we could notice it, but he thinks that could be what signals the end of empire. Yes, I'm not having a go at Americans. I'm having a go at the deep state American empire that's been really in place since the end of World War II. That makes a lot of sense. That makes a lot of sense. But is it going to happen this week, next week? Who knows? It could be next year. But I thought that was really interesting. It would correspond with the end of empire, a big crash in the Dow, and he thinks the crash in the Nasdaq and S&P would be even bigger because they're highly leveraged to the tech sector. And I think there are some very smart investors out there. Well, probably one of the arguably the smartest one ever, Warren Buffett, whose company now has almost $400 billion in cash. He doesn't see value out there. So who knows? And there's an indicator he looks at, the U.S. stock market cap. Globally, the U.S. divided by GDP, and that's the highest it's ever been. So I did some more charts. Actually, he was cooking, and he left me in his study or his office looking at all these numbers. So, and these charts, and I printed this one out. It's the gold-silver ratio from 1500 BC, yes, BC, to 2008. Gold, silver. Silver is in German, doesn't matter. It's a very similar word, isn't it? But you can see here that it's been below 20, well, throughout history, except in the 20th century, where we've seen it go up massively, of course. This is only till 2008, but it doesn't really matter. It's just to get you an perspective that right now where we are around 80 or above 80, or where we were recently above 100, is a total aberration of 3,000 year history. And some people might say, oh, it's different now, but I'm not sure. I'm not sure it's different now. So I think there's a very good chance we'll go back to 15 to 1, 16 to 1. We could even undershoot because we've overshot for so long, right? So I thought that was interesting. He's very bullish silver. So am I, and I'm still, of course, bullish gold. I saw a report from the analyst from the World Gold Council, he's updating that Brazil bought more gold. And I saw last week that Korea, there's rumors Korea is buying more gold. That's South Korea, of course. And South Korea hadn't bought gold for a long time. So we should be seeing soon reports that South Korea has added to their gold stash. And that's significant because South Korea is an ally of the US, and now they're starting to buy gold again. Maybe South Korea is gonna have a foot in BRICS and a foot in the West. Who knows? I think that's huge. It just goes to show that the world's moving away from the dollar as a major reserve asset, and they're moving towards gold, and it's not going to stop. And I think actually gold could surprise everyone on the upside in the next few months, because I think a lot of people are bearish now after the correction that we've had. They're saying, oh, it's going to be months till we'll make new highs. Some people are saying it's the top, that gold is a bubble. I don't think gold is anywhere near a bubble. It's still heavily underinvested. It's the central banks that are front running the public and investors. And I think investors next year, as Clive Thompson has said, they're going to look at the performance of gold, silver, and the miners for 2025, and they're going to ask their fund managers, their wealth managers, their bankers, why didn't you put me into gold? Please get an exposure to gold. So yes, it's a golden age. Revaluation, that's still in the cards, isn't it? And I noticed President Trump said that there's going to be 20 trillion injected into the U.S. economy still in 2025. I'm not sure where he's getting this number from, whether foreigners really want to invest 20 trillion while they're getting away from the dollar, or maybe he's thinking of revaluation of gold. Who knows?
Gold's trajectory continues to mirror the slow erosion of purchasing power in the global fiat system. The long-term arithmetic remains clear. As currencies are inflated, tangible assets like gold must inevitably rise in nominal value. Short-term declines may shake out weak holders, but they don't alter the structural reality of currency debasement. Each correction resets the market for stronger hands and more committed capital. Silver, meanwhile, plays a dual role as both an industrial and monetary metal, a paradox that intensifies its volatility. When confidence in fiat weakens and generalist investors rotate toward tangible assets, silver often accelerates faster than gold, reflecting the greed phase of a bull market. As tokenization technology develops, precious metals could once again serve as both a store of value and a medium of exchange. The infrastructure for this transformation already exists. Its adoption is only a matter of time. Let's get back to the interview.
Will gold increase threefold or fourfold? I don't know. My crystal ball is cracked and cloudy. It only makes arithmetic sense that gold priced in dollars will increase in a fashion that mirrors the decrease in the absolute purchasing power of the US dollar. By the way, I don't think that the US dollar needs do poorly against other fiat currencies. My friend Doug Casey once said the US dollar is the worst currency in the world, with the sole exception of all of the others. So I'm not suggesting to you that the US dollar does poorly compared to the Canadian dollar, the New Zealand dollar, the euro, the pound. I'm just saying in an absolute sense that there's going to be a reckoning. In the decade of the 70s, and by the way, I was around and in the game then, that decade was spectacular for gold. It went from $35 to $850. Many people don't remember that in the middle of that bull market in 1975, if the gold price were to fall, let's say next February, the price of gold was to fall from 4,000 to 3,000. A lot of people who today characterize themselves as gold bugs would wish they never learned to spell gold. But that price decline will not in any way, shape or form change the arithmetic around the US dollar or the probability of a soft default. Gold, I would suggest, if it fell by 25%, which would scare people out, would be a substantially better buy after than before, because the outcome's the same, irrespective of the near-term price movement. I save in gold. I think of it sort of as an insurance product, but insurance against the depreciation, the purchasing power of the US dollar. I maintain liquidity in dollars, in very, very short-term treasuries, but I personally save in gold. I invest in high-quality gold stocks. I'm willing to take operational risk in those companies because I believe that an increase in the gold price increases their margins faster than it increases their cost. And I speculate in higher risk, lower quality gold companies. So the gold sector fulfills all three roles for me. I save, I invest, and I speculate across those three asset buckets within the so-called gold group. The silver price paradox has to do with the fact that silver is both a monetary metal, I believe, and an industrial metal. People who are making a case for silver as a monetary metal forget the fact that the increased nominal price of silver reduces its utility in industry, and the increase in the price of silver reduces its industrial demand and cannibalizes that demand. At the same time, that on the monetary side, silver is a Geffen good, which is to say that as the price increases, that increase in price validates the narrative. It's a very, very odd metal. I've studied the silver market for 50 years, and I need to disclaim at some point in time in this answer that after 50 years of study, I'm not sure I understand it. Understanding silver supply is hard because silver mostly doesn't come out of silver mines. It comes out of recycling or gold mines or copper mines or lead mines or zinc mines. So to understand supply in silver, you have to focus less on the price of silver and more on supply and demand for things like copper, lead, and zinc. So getting an accurate supply handle is hard. It's hard too because a whole bunch of silver doesn't show up anymore, anywhere. A whole bunch of silver is owned by private owners in India, Pakistan, Bangladesh. They don't want to be taxed on it. And so it's unreported. When the price of silver, particularly in US dollar terms, goes up and the rupiah falls against the US dollar, times like right now, incredible price escalation in Indian terms. And that sometimes leads some supply to come out on the market. And the demand side has been hard for me to understand. What I know about the demand side as a monetary metal is this. Precious metals bull markets are led by gold. Always. They're led by the fear buyer. And the price escalation has to do with the absence of selling, which is to say the sellers get used up. And when the fear buyers emerge, they can take the price of gold up relatively rapidly. When the price action in gold, when the momentum in gold has justified the hard money narrative to generalist investors, not precious metals investors, but the generalist investors, which is precisely what you're seeing right now. Bank of America, Merrill Lynch, Goldman Sachs, all those guys. Yeah. When the generalist investors come into our space, precious metals, leadership changes from gold, from the fear buyer, to silver for the greed buyer. I don't know why this is, Darcy. I suspect it's because of the lower unit cost, or perhaps because of silver's reputation for volatility, or both. All I know is that in the three precious metals bull markets that I've survived prior to this one, at some point in time when the generalists came into this space, silver began to outpace gold. The last 4 or 5 weeks might suggest that we're in that period now, leaving the last week out of it. This I know. When that happens, when the uncoupling happens, and I think it's when, not if, you won't need rickrule to tell you it's occurring. Those are dramatic circumstances. I've had the pleasure of living through that 3 times long, and I'm hoping to live through one more event like that. In my experience, when the gold and silver price decouples, that the silver price outperforms the gold price about 2 to 1. From a conjectural perspective, then, if I was one who believes that the gold price should go up threefold in the next 10 years, that would suggest that the gold price goes up sixfold. Right. Is that a projection? I'm not smart enough to give you one. I'm just repeating history as I've lived through it. I don't know how. I don't know why. I just know that. Silver is, as we speak, a medium of exchange in rural India, Pakistan, and Bangladesh. Not an official medium of exchange, and it's impractical, as you suggest. It's heavy. People can steal it from you. It's difficult to make change in. But in illiquid societies, or in societies where a lot of transactions take place, let's just say off balance sheet, it's already a medium of exchange. It's important to know that. Tethered tokenization and coinage, that is to say crypto coinage, changes really, truly everything. The technology exists today for a gold token, and I think that the regulation and the infrastructure will exist within 2 years, where you will have precious metals stored in a recognized exchange, that is to say a recognized vault, and what are in effect delivery receipts, which are redeemable for physical precious metals, will be established in trusts and then tokenized. I know that the World Gold Council and the LBMA is working on that as we speak. I know that the technology exists. Regulatory adaptation will be slow because governments understand that good money drives bad money out of circulation.
Yep.
But the first time a country breaks, Liechtenstein or anywhere else, and you have a gold token or a silver token where you can walk into a Starbucks and pay for your coffee in a fraction of a gram of silver, and where the merchant can store up those fractionalized payments and redeem them for physical silver if he or she wants. The transaction costs around transactions and the transaction costs around storing silver become much, much, much more efficient. And the metal becomes then what it was 100 years ago, which is to say both a medium of exchange and a store of value. And as I say, the technology for this exists today. I think the biggest private buyer of gold in the world right now is Tether, using it to secure a stable coin. And the whole technology around issuing securities redeemable in gold was pioneered by us at Sprott. That's now a $40 billion business. Would buy physical gold, silver, platinum, palladium, stick it in the Royal Canadian Mint. We used to joke, by the way, our security was provided by NATO. And then we would sell trust units, which were, in quantity at least, redeemable for physical gold, silver, or platinum and palladium. Importantly for American investors, and this was an afterthought, but it turned out to be very beneficial, in the U.S., transactions in gold and silver are characterized by the IRS as collectibles, and they're taxed at the income rate, but the trust units are taxed as securities at the capital gains rate. But the point of it is that the practice of storing gold in a recognized exchange facility and having it redeemable and having audit procedures in place all exists today. This doesn't need to be invented.
The global financial landscape is shifting faster than most realize. We're entering an era where gold and silver are no longer just safe havens. They're reasserting themselves as the foundation of real value. Central banks are accumulating, institutions are quietly repositioning, and the monetary system itself is inching toward revaluation. The evidence is all around us, from the declining trust in fiat currencies to the growing push for asset-backed digital systems. Precious metals are poised to play a pivotal role in this transition, bridging the gap between traditional finance and the emerging sound money architecture. As this transformation unfolds, the next phase will likely favor those who hold tangible assets over paper promises. The setup for the coming decade points toward historic price adjustments, not speculation, just mathematics and monetary reality catching up. Stay ahead, stay informed, and stay ahead of the curve. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.